Are you looking for ways to maximize your savings? Well, you're in the right place. We're all familiar with the concept of saving, setting aside a portion of our income for future use. But here's the thing, merely saving isn't enough. Your money needs to work for you, not just sit idle. Let's take a moment to consider traditional savings accounts. They are safe, yes, but they have low interest rates. In fact, these rates are often so low that they don't keep up with inflation. That means over time, the purchasing power of your money in a regular savings account is likely to decrease. It's like running on a treadmill. You're moving but not going anywhere. So if a regular savings account isn't the best place for your hard-earned money, where should you put it? Let's find out. The first option to consider is a high-yield savings account. Now, what is a high-yield savings account, you may wonder? Well, it's just like your regular savings account, but with a twist. It offers much higher interest rates. Think of it as your savings account on a heavy dose of Vitabucks. Instead of the paltry returns you might see with a standard savings account, perhaps around 0.05%, a high-yield savings account kicks those numbers up a notch, for example, to a much more appealing 5%. This gives you more bang for your buck. The reason for this is that banks are competing for your business, so they're willing to offer higher interest rates to attract you. It's a win-win situation. They get your business, and you get more money. Opening a high-yield savings account is as simple as pie. Most banks offer an online application process that's as smooth as silk. You fill in your personal details, deposit your initial amount, and voila, you're all set. Now let's talk about examples. Banks like Ally Bank, Marcus by Goldman Sachs, and Capital One 360 are famous for their competitive interest rates of up to about 5%. But remember, rates can vary, so it's always a good idea to shop around. The beauty of a high-yield savings account is that it offers more growth without any risk. Unlike some other investment options, your money is safe. It's insured by the Federal Deposit Insurance Corporation up to $250,000. With a high-yield savings account, your money grows faster, without any additional risk. If you're seeking a secure investment strategy, Treasury bills, frequently termed as in the financial world, might be your best bet. These are short-term securities provided by the U.S. government. Purchasing a T-bill equates to lending money to Uncle Sam. Rest assured, he's trustworthy. The government guarantees your investment, making T-bills one of the safest investments available. They are available in a range of durations, from as short as a few days up to a maximum of 52 weeks. Once they reach maturity, the government pays you back the full face value. The profit margin between your initial investment and the final payout at maturity is your interest or return. For instance, if you bought a T-bill for $950 and the face value at maturity is $1,000, that's a return of 5.26%. So, how do you acquire these T-bills? They can be purchased directly from the U.S. Treasury via their official website, or alternatively through a broker or bank. The minimum starting amount is as low as $100, making them within reach for most. However, bear in mind that T-bills aren't a quick-rich scheme. They're more of a slow and steady approach to wealth accumulation. The returns, although modest, are reliable. So if you're seeking a secure place to deposit some savings, or are a novice in the investment world, T-bills could be an excellent first step. They're straightforward, low risk, and yield a guaranteed return. Treasury bills are a fundamental pillar for any savings strategy. Now, if you're willing to take a bit more risk for potentially higher returns, consider high-dividend ETFs and mutual funds. What are ETFs and mutual funds, you ask? Well, ETFs, or exchange-traded funds, are investment funds that are traded on stock exchanges, much like individual stocks. They're designed to track the performance of a specific market index, sector, commodity, or asset. Mutual funds, on the other hand, are investment vehicles that pool money from many investors to purchase a diversified portfolio of stocks, bonds, or other assets. Now, high-dividend ETFs and mutual funds are exactly what they sound. They focus on stocks that pay high dividends. For instance, it's not uncommon to see high-dividend ETFs and mutual funds generating annual returns of around 3 to 5%. Dividends are a portion of a company's earnings that are paid out to shareholders, and high-dividend investing can be a great way to generate income. So how do you invest in these power players? It's fairly straightforward. You can buy ETFs and mutual funds through a brokerage account. Many online brokerages offer a wide selection of ETFs and mutual funds, so you can pick and choose based on your financial goals and risk tolerance. But here's the key: diversification. By spreading your investments across different types of assets, you can potentially lower your risk. If one sector of the market falters, your other investments can help to offset those losses. And remember, investing is a long-term game. While the market may fluctuate in the short term, over time, it has historically trended upwards. In conclusion, high-dividend ETFs and mutual funds offer a way to potentially earn significant returns. As I mentioned before, it's not uncommon to see around 3–5% annual returns. They're a bit riskier than a savings account or treasury bills, but with that risk comes the potential for greater reward. And with a diversified portfolio and a long-term perspective, you can navigate the ups and downs of the market with confidence. With high-dividend ETFs and mutual, you can potentially earn significant returns over time, and it's not unusual to see 3–5% annual returns. So, we've explored several ways to maximize your savings. We started with high-yield savings accounts, a secure option offering more bang for your buck. Then we moved on to treasury bills, the safe bet for those who want a risk-free return. And finally, we delved into the world of high-dividend ETFs and mutual funds, the power players for those willing to take a bit more risk for potentially higher returns. But remember, there's no one-size-fits-all solution when it comes to investing. It's crucial to research and choose the best option that aligns with your individual financial goals and risk tolerance. Perhaps you'll find a mix of these options is the best route for you. Ultimately, the key to growing wealth isn't just about making money, it's about making your money work for you. Whether it's through a high-yield savings account, treasury bills, or high-dividend ETFs and mutual funds, your money can grow and generate more wealth over time. And here's the bottom line. It's not about how much money you make, but how much you keep and how hard it works for you. Start maximizing your wealth today. The sooner you start, the sooner you'll be on your way to achieving your financial goals. If you enjoy contents like this, subscribe to this channel. Don't forget to like and share this video.